Hey everyone, and welcome back to the channel. Today, we're diving into a story that's sending shockwaves through Wall Street. The Federal Reserve just dropped a bombshell, and it's causing absolute chaos for anyone betting against the banking sector. We're talking about a $20 billion event that has short sellers scrambling and banks breathing a sigh of relief. So what exactly happened? How did the Fed manage to completely flip the script on the market? And what does this mean for your money and the future of banking? Stick around, because we're breaking it all down. Let's set the stage. For the past year or so, there's been a lot of nervousness surrounding regional banks. After the collapses we saw last year, many investors, particularly short sellers, started placing huge bets that more banks would fail. They were essentially profiting from fear, predicting that rising interest rates and commercial real estate woes would bring these institutions to their knees. For a while, it looked like they might be right. The sentiment was bearish, and the pressure was mounting. Every piece of negative news seemed to feed this narrative, and short positions were piling up. But then, the Federal Reserve stepped in with something called the Bank Term Funding Program, or BTFP. This program was initially created as a lifeline during the banking crisis last year. It allowed banks to borrow money from the Fed using their bonds as collateral, valued at their original price, not their current lower market price. This was a crucial backstop that helped stabilize the system. However, the program was scheduled to end in March. As that deadline approached, many short sellers doubled down on their bets, thinking that once this safety net was gone, some banks would be left exposed and vulnerable. They were anticipating another wave of panic, and that's where the story takes a wild turn. Just before the program ended, something unexpected happened. Banks, in a coordinated and massive move, drew down an astonishing amount of money from the BTFP. We're talking about a surge of nearly $20 billion in the final week alone. The total outstanding balance of the program shot up to a record high of over $165 billion. This wasn't a sign of desperation. This was a calculated, strategic move. The banks weren't borrowing because they were in trouble. They were borrowing to build a war chest. Why would they do this? It's a brilliant piece of financial maneuvering. The interest rate on these BTFP loans was relatively low, around 4.9%. Banks could take this cheap money and simply park it in their reserve accounts at the Fed, where it earns over 5% interest. This is what's known as arbitrage. They were basically getting paid to borrow money. It was a risk-free way to bolster their balance sheets and create a massive cash cushion. This move sent a powerful message to the market. We have more than enough liquidity to weather any storm. The impact on short sellers was immediate and brutal. This is what we call a short squeeze. The shorts were betting on bank failures, but this massive injection of cash completely undermined their thesis. With banks suddenly flush with cash and looking stronger than ever, the stock prices of these regional banks started to soar. As the prices went up, short sellers were forced to buy back the shares they had borrowed at a much higher price to cut their losses. This buying frenzy only pushed the stock prices even higher, creating a vicious cycle for them. Billions of dollars in short positions were vaporized almost overnight. It was a masterclass in how to turn the tables on market pessimists. So, what does this $20 billion shockwave mean for the bigger picture? First, it shows that the banking system, especially the regional banks that were under so much scrutiny, is more resilient and strategic than many believed. They didn't just passively wait for the market to decide their fate. They actively used the tools at their disposal to strengthen their position and fight back against negative sentiment. This proactive stance has restored a significant amount of confidence in the sector. Second, it highlights the immense power the Federal Reserve holds over the markets. The BTFP, even in its final days, proved to be an incredibly effective tool. While its primary goal was stability, it ended up being the weapon that turned the tide in this specific battle between banks and short sellers. It raises questions about the long-term role of such intervention. But in the short term, it worked exactly as intended and perhaps even better. For the average person, this is actually good news. A more stable banking sector is good for everyone. It means your deposits are safer, and it reduces the risk of a wider economic crisis triggered by bank failures. It also shows that the panic and fear that dominated the headlines might have been overblown. While there are still challenges ahead, especially in commercial real estate, the banks have shown they have the resources and the strategy to manage these risks. Now, let's talk about the road ahead. The BTFP is over, but the banks are now sitting on a mountain of cash. This gives them a powerful buffer to navigate the current economic environment. They can use this liquidity to manage potential losses from bad loans, particularly in the office and retail property sectors. It also gives them the flexibility to continue lending to businesses and consumers, which is essential for economic growth. The short sellers who got burned will likely be much more cautious about betting against the banks in the near future. This event has served as a painful lesson that fighting the Fed, and by extension, the banks armed by the Fed, is a dangerous game. This could lead to a period of lower volatility for bank stocks, as one of the major sources of downward pressure has been neutralized. However, it's not all smooth sailing from here. The core issues that made investors nervous in the first place haven't entirely disappeared. Interest rates are still high, which puts pressure on bond portfolios, and the commercial real estate market is still facing a significant downturn. The difference now is that banks are in a much stronger position to handle these challenges. They've bought themselves time and built up their defenses. In conclusion, this $20 billion move was more than just a clever financial trick. It was a pivotal moment that reset expectations for the entire banking industry. It was a coordinated show of force that decimated short sellers and restored a huge amount of confidence. It demonstrated that even in the face of widespread pessimism, banks had a powerful ace up their sleeve. The panic that seemed to be building has subsided, replaced by a newfound respect for the resilience of the financial system. The shorts learned a very expensive lesson, and for now, the banks have won. What do you think about this incredible story? Were the banks right to use the Fed's program this way? Or does it create other risks down the line? Let me know your thoughts in the comments below. I read every single one. If you found this breakdown helpful and want more deep dives into the stories moving the markets, make sure you hit that like button and subscribe to the channel. It really helps us out. Thanks for watching, and I'll see you in the next video.